psyop, psychological ops wise, psychologically incentivized to like into this albatross of high risk investing in order to get yield, as opposed to like the normal the conscientious way of saving, investing, and getting the fruits of your investing and returns, and that kind of being completely twisted. He gives this beautiful quote from Bernanke's, and he says that this quote is the Rosetta Stone. It's the means of translation of all of Bernanke's moves going forward. And I'm going to read it out. I wrote it down because it was that terrific. Like I was like, okay, gotta read it. I gotta look at this later to keep it like a framed picture anytime we're pushed into higher risk things. And you should listen to the weird and circuitous language in which Bernanke writes. It will pay to invest when the cost of waiting exceeds the expected gains from waiting. The expected gain from waiting is the probability that new information will make the investor regret his decision to invest. The motive for waiting is the concern of the possible arrival of unfavorable news. Didn't it make your head just spin? Like all these words? Like, I just made my head spin. I was like, wait, it will pay to invest when the cost of investing exceeds the expected gains from waiting. Okay. So it's not going to pay me much to wait, i.e. zero interest rates, right? Or very low interest rates. The expected gain from waiting is the probability that new information will make the investor regret his decision to invest, meaning expecting bad news. The motive for waiting is the concern of the possible arrival of unfavorable news. Yeah, the SHTF basically. And so in that sense, this and then he describes it in the context of this whole BS notion of forward guidance. And then he talks about risk and uncertainty. And risk is basically the concept that an investor can apply a known probability to an event and then make a decision to invest. But uncertainty is even it's a random outcome with unknown probability. And those two, that difference between risk and uncertainty is something that I think we all need to ponder, because what's happening lately is like we're herded into this albatross of ridiculous investing. It's almost gambling. It's not even investing anymore. It's gambling. And it's because of this difference between risk and uncertainty that has not been properly the definitions of those two words have been so mucked up that it's hard to parse them both out. Now, the most valuable bit from this book, I think, well, one of the most valuable things, because there are many when I listen to the second time, is the case that he makes for the euro, or for the survival and strengthening of the euro. Now, mind you, this book was written in 2014, and he goes quite a bit into the history of Charlemagne, and let's see, I wrote down quite a bit here because it was quite beautiful. Yeah, the way so Charlemagne Charlemagne was around in AD 814, or no, it ended in AD 814, but basically, this conglomeration of kingdoms that happened during Charlemagne's reign is sort of very similar to the EU of present day. And he talks about how Charlemagne really pioneered quantitative easing by introducing the silver standard, so a cheaper standard basically than gold. But he was kind of the pioneer of that whole thing. And he really draws the parallels between the similarities of Charlemagne's reign and the similarities between the present EU, meaning like the tendency of so Charlemagne had this thing where you don't unnecessarily force like uniformity on everything. You allow diversity as long as it pushes forward that common agenda, and you only switch it over to uniformity if that diversity grossly challenges that order that you're trying to like keeping local customs and only applying standardization if it serves the greater good or it serves the EU kind of motives. And he talks about a lot of like currency manipulations, let's just say, in the euro that occurred between 2011 and 2014 timeframe that prove that the proof why the euro is being preserved, because it's a political. The need for it is political. The need for it is not financial. And he really talks about in this book, Currency Wars, about how not Currency Wars. Sorry, Currency Wars was the previous book. But so many of the concepts are like taken further. In Currency Wars, he talks about how, and I have made a review about Currency Wars. In Currency Wars, he really talks about how when a country is playing a currency war, the goal is not financial gain, but the defeat of the other person's financial markets, and how it costs you like these many millions of billions to wage a war. So even those like lost investments of the person waging the war are considered as cost of war, basically. So they don't really care about that, I'm going to play this and my currency should gain more. No, that's not the agenda of a currency war. And so in that sense, he describes how the euro has a case for remaining. And I wouldn't say remaining strong because it's sometimes strategically weak as it is right now. And I know this because I've been following the charts, the currency charts, and the dollar USD, euro, USD CNY, and euro CNY. And if you want to know more about this, I highly recommend looking up a guy by the name of Francis Hunt. He has 3 channels on YouTube: the Market Sniper, the Crypto Sniper, the Reset Sniper. But just look up Francis Hunt currency charts, and you'll find something, especially the euro stuff. Yeah, it's well substantiated.